Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Markets in the Asia Pacific will be affected by a holiday-shortened week in the States. No trading in cash markets on Monday in the U.S. in observance of MLK Day. And as such, no trading today in U.S. Treasuries in the Tokyo session. Do remember, the Bank of Japan has a rate decision on Friday. At the moment, U.S. stock index futures are trading, and the S&P 500 E-minis contract is down about 0.8%. This as members of the European Union look at options for how to respond to President Trump's use of tariffs as punishment for EU support of Greenland. We're told the European Union is considering retaliatory levies on about $108 billion worth of U.S. goods. Treasury Secretary Scott Bessent spoke with NBC's Meet the Press, and he insisted the U.S. move on Greenland is about national security.
We have seen the Europeans are unable to push back against Russia. The U.S. is this war that never would have started in Ukraine, Kristen. We are going to settle it, but it wouldn't have started. And what President Trump is trying to do is prevent a taking or the Russian-Chinese action in Greenland in the future. So why not be strategic?
That is Treasury Secretary Scott Bessent speaking to NBC's Meet the Press. We're seeing some weakness in equity markets right now across the Asia Pacific. We'll get some perspective now from Julia Wang, North Asia CIO at Nomura. Julia spoke earlier with Bloomberg TV host Shery and Avril Hong.
We have so much to contend with. Of course, we talked about all of the risks around geopolitics, not to mention we do have eco data out of China today. And of course, we are also contending about what happens to the Fed chair and any comments that could come out from President Trump in Davos. Amid all of this noise, what are you focusing on to see sort of the direction of Asian assets?
Sure. Good morning, everyone. Thanks for having me. So, when we look at markets for this year, we really think that we are in a very different investment environment compared with the last couple of years. Really now, this year, we're starting to see some big structural shifts really coming ahead in markets. So, against all the constant noise that you just mentioned, the one constant everybody notices now is geopolitics and deglobalization. And we think that this year we'll see so many headlines around geopolitics that it will just become a new normal as we invest. So we think that, hedges against geopolitical risk becomes a necessity for investors this year. We do think that the market generally, the global economy generally are still looking quite good from a fundamental perspective because we have long-term growth drivers like AI really accelerating in 2026. We have policymakers that largely still have the back of the markets, be it fiscal policy globally or monetary policy from select countries. So the setup still looks good. But we do think that this year diversification is really important because of all the risk, the headlines, volatility we'll likely see. That means that investors should not chase momentum, but instead they should look at value and compare that with growth. So we really think that diversification is important, and Asia really stands, I think, at a very unique juncture amongst its mega forces because it has strong growth, it has secular growth such as AI, it has a relative stable economic policy, unlike some of the volatility and surprises we can see from Western economies. Asia, I think, is becoming a source of stability from at least from an investor perception perspective, and that could benefit Asia assets generally speaking. We do think that valuation generally in this part of the world is still pretty attractive as well.
Even when you see, for example, Chinese tech companies and the Hang Seng Tech Index up, 13% this month already?
Yeah, I think that we look at China tech space. We really think there are two things that are starting to improve, right? One is, of course, we mentioned earlier, AI now is going global, and we know that increasingly China has its own strategic path around AI. That's related to how AI is developed in the West, but it's not completely on the same path. So I think it's a very interesting alternative exposure to AI development, and the pace of monetization escalation is also faster in this part of the world. And secondly, I think that, related to the geopolitical angle that you mentioned earlier, China is somewhat shielded from, all this volatility around tariff policies or geopolitics, U.S., Europe relationship, things like that. I don't think it benefits as much, but it's, I think, a source of stability from an investor perspective that could benefit, this market because it could attract some diversification flows. So I think the AI angle and the diversification angle are still beneficial for Hong Kong market, and particularly the big, large tech companies.
And yeah, Julia, not all AI-related companies are created equal. Do you have a preference, perhaps, for hardware versus software when it comes to Chinese tech?
Yeah, so I think that, when it comes to the broader way of playing AI, we have, 2 or 3 favorite ways to do it at the moment. If we think about AI supply chains, we think that could be really interesting this year, be it memory, which has already done so well out of South Korea, or hardware generally in North Asia. If you think about all these components that are now seeing significant increase in demand, which are outpacing their supply, that could be North Asia, that could be Greater China, it could be Korea. It could also, to some degree, we think in the future, spill over into Japan as well, because they're more upstream at this point. So I think that this segment out of AI, it's undervalued, it's overlooked, and it could benefit because AI capex spending is ramping up globally, not just in the US. And particularly, I think for China, when we think about large tech companies, we think that there are a broader angle to play AI, because they're not necessarily just the infrastructure or the hardware. Instead, there are platforms towards which some degree of monetization could also start to happen. If we look at user engagement for large tech companies, they're starting to monetize at the same time as investing. So it's really the whole life cycle really at play when we look at large tech companies in China as well.
Aside from AI, how else can investors diversify at a time where, as you mentioned earlier, you got geopolitics in the backdrop? Is the attention supposed to be a bit more on these resource-rich markets? And how do you think we should go about it?
Yeah, so I think that's a very interesting point, because there's clearly a rush, earlier this year, since the beginning of this year, towards commodities, and that's maybe on the back of the geopolitical shadow that's being cast around the world. Now, investors are noticing that there's a grab for resources. There's be it rare materials, be it and just normal commodities in general. So that is, I think, creating a bit of a push for the commodity complex. I do think from an economic cycle perspective, we do think that you still have to be quite careful to think about this as a baseline asset allocation, because we do think that there's a small risk the U.S. economy goes into overheating or inflation goes out of control, in which case these assets could benefit like they did in 2021. We're not quite there yet in terms of our economic forecast. We think that chances are that we're still going to have relatively robust global growth, but we don't think inflation will necessarily fly as a base case. So I think that yes, there's a geopolitical angle that supports commodity in general, but I do think you have to be quite tactical around it, because a lot still depends on that inflation risk, and when it comes roaring back, it's not our base case that it does. So I think that one part of the commodity complex that we do like is actually precious metal, because it has a more tried and tested relationship with geopolitics. Increasingly, there's a consensus that precious metal is what you use to hedge geopolitics, and we just mentioned it's a constant in markets now. So we think that does deserve a strategic allocation in of itself.
Yeah, you can see gold right there trading at record highs again. But Julia, just before we let you go, how will you be factoring in the currency mechanism? Of course, when we talk about geopolitics, when we talk about central bank policy, the U.S. dollar and what happens on the other side of the trade with all of these Asian currencies have also ramifications.
That's a great point. I think, obviously on the back of what happened overnight in terms of news flow, you could see a bit of a dollar strength, just because bilateral tariff threats are always in favor of U.S. dollar, it being the largest consumer in the world. But I do think that if we see an escalation, another round of tariff war, an escalation on the back of these threats, then going back to what happened in April last year, the dollar weakened continuously going into Liberation Day. So if we see that a severe escalation of trade tensions, tit for tat, tariff really starting to happen, becoming more of a reality, I think the dollar actually could, there be a limit to how much the dollar can really benefit from that. Instead, as an investor, we'll start to think more about diversification into assets where there may be a short-term hit, yes, so their top line from a revenue perspective, but their assets are cheaper and they have independent source of growth, be their domestic fiscal policy, a monetary policy, or technology development. And Asia, I think, fiscal policy is being ramped up in Japan and being in China. Asia has an AI angle to it as well. So we think that over the medium term should support Asian currencies, generally speaking, maybe to the exception of the yen, where we do think they continue to stay weak for a little bit longer.
That is Julia Wang, North Asia CIO at Nomura, speaking with Bloomberg TV host Shery and Avril Hong. And we're bringing it to you here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. President Trump is intending to announce his nominee for Fed chair within the next few weeks. It was last Friday the president said he wants to keep Kevin Hassett, the director of the National Economic Council, in his current role. Well, Hassett had once been seen as the front runner. Today, Hassett told Fox News the president may be right to pass him over.
From the beginning, he and I have talked about whether it's better for me to be here in the West Wing or over at the Fed. I don't think he's made a final call on that. But I got to say that I'm even humbled still, perhaps, to be in the running with the other people.
That is NEC Director Kevin Hassett. For a closer look at what may be next for Fed leadership, I'm joined by Bill Campbell. He is Global Bond Portfolio Manager at DoubleLine. Bill, thanks for being here. We both know that Powell's term expires in May. Perhaps this is no longer a four-man race. Maybe we've come down to three candidates. I mentioned Hassett. This list also includes Fed Governor Chris Waller, former Fed Governor Kevin Warsh, and then there's Rick Rieder, the CIO of fixed income at BlackRock. We're being told right now that Rieder's candidacy has gained a fair amount of momentum. Do you think the administration got feedback from some influential market players, and maybe they voiced some concern about putting into this position a person that may be overly dovish or perhaps more problematically seen as carrying water for the administration a bit?
When we look at the fact that the president hasn't made the announcement yet, clearly, I think that this list, nobody is, really has caught his attention or has, caught the spark in his eye just yet. I like the idea that Rick Rieder's candidacy is starting to, gain a little bit more momentum. When we looked at the poly markets last week, he was down at the bottom. It was Kevin Warsh that jumped up to the top. And I feel that, Kevin Warsh and, Chris Waller, for that matter, although more orthodox candidates, may not be willing to, as you stated, carry water as much, for the White House and for this administration. I think that Kevin Hassett, the concerns around Kevin Hassett, maybe it was more concerns about, Fed credibility or being able to get, the board to vote in line with what the chair wants. We've seen a lot of discussion about the Fed moving more towards a Bank of England model where everybody has a vote. And that would be a move away from what we've currently seen of the chair being able to pretty much gain consensus. And then where there are dissents, it's to signal to the market, what the committee is, trying to signal that maybe they plan in the future to move in a direction. With Hassett, I think the concern was it would be a bunch of independent votes. And, that I think for the Trump administration, less the concern, like you said, that he wouldn't carry water, but more the concern that he couldn't affect the outcome that the Trump administration would want. So maybe Reader would have a little bit more of that gravitas. And I think there are concerns about Kevin Warsh and especially Chris Waller that they might be too independent and may decide that aggressive cuts may not be warranted and not push for that.
Also on Thursday, the Supreme Court will be hearing oral arguments in the case Trump v. Cook. This is very important in terms of deciding whether the president has the power to fire Fed Governor Lisa Cook. And it's being viewed as a critical case because it's going to essentially address this removal protection that's been afforded members of the Board of Governors. And obviously, it's coming at a time when the issue of Fed independence is right at the top of the list for markets that are very keen, as you just kind of alluded to any form of political pressure. A week ago, we were talking about the DOJ issuing subpoenas to the Fed over statements by Powell. Obviously, that's related to the renovation project of the Fed's headquarters. But this criminal probe just looming over markets right now. The Wall Street Journal had a survey of economists talking about the criminal investigation running the risk of damaging not only investor confidence, but weakening the dollar at a time when China is expanding the use of its own currency around the world. Are we at a situation here that could be maybe a little bit more precarious than the market believes right now? Or is this noise and we really need to kind of focus on the signal?
You asked a lot of great questions, and I'm going to, try to tackle them, one by one. I do think, the Lisa Cook oral arguments, let's see exactly what's presented, to the Supreme Court, the type of questioning that comes out to see, the court has been taking somewhat of a favorable attitude towards this administration. So I think that would give us a potential hint as to the latitude that they might provide this administration as far as being able to remove governors. I think the Powell investigation is something that needs to be taken very seriously. I question the merits of these underlying subpoenas that have gone out and the intention for it. It was two quarters ago that we really dealt with this. And, I do think that Powell, in my understanding, kept Congress apprised of all of, the budget changes that were happening with the additions, with the renovations at the Fed. And if we are, using a justice system to affect economic outcomes, I think there needs to be separation. In the way that our government was set up was a separation of powers, and I think that that is a core tenet of confidence that underlies investment in the U.S. So I think we have to keep a very close eye on Powell, but I do think now the outcome of the subpoenas needs to be watched closely. And then you mentioned China. Obviously, we are starting to see slowly the questioning of U.S. institutional strength, whether it comes to Fed, whether it's around Fed independence. We also now have questions about data veracity. Yes, we had the government shutdown, but there's questions about, as I discussed on the housing side, how we're statistically calculating things. There are other elements that are popping up as well. And we have a large foreign investment in the United States that has built up over the past 2 decades. And the concern there is, as the questions rise around, institutional credibility and independence, not only of the Fed, but really of all institutions in the U.S., that has the ability, to shake investor confidence internationally, and it could cause a rotation out of U.S. investment internationally. And one final point that I just, I've been mulling over, and maybe just since we're talking, it's worth bringing up in this context. You were talking about China, and although China has been expanding their trade and their currency use across the globe, quietly, if you look at the Treasury, the TIC data, the Treasury International Holdings data that they have in custody at the Fed, there's been a reduction of U.S. Treasuries held, in custody for China. And it's been a meaningful reduction over the past, several quarters and actually over the past several years. The most recent tick data shows that, despite a little bit of Treasury volatility, we've seen, Treasury rates generally hang in there because there's other buyers that have stepped in. It's been the UK, the EU, and Japan. And I have to believe that a lot of this is around negotiations that we had around trade. Now, going forward, if we are, going to Davos and starting to really question the underpinning of the relationship between the U.S. and these nations and the European, the UK, and the Asian nations, I think that also could present a risk of who's going to fund the Treasury issuance that's going to be coming to fund our large deficits over the course of the next several years as well. So it's not just a concern on the currency. I think we need to take a careful. We need to be very careful about the perception and the reality of institutional erosion. In the U.S. because the large foreign investment, over 60 trillion of foreign investment sitting in the U.S. easily could start to be allocated away, and that would put a lot of volatility back into markets.
Bill, we'll leave it there. Thank you so much. Bill Campbell is Global Bond Portfolio Manager at DoubleLine, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.